I'd like to begin with a few questions. Have you ever tried na tumaya sa loto? So, kung hindi, maybe because iniisip natin na ito ay hindi natin interest. Or possible na naisip mo na napakaliit ng chance or halos walang chance na manalo ka sa loto. At doon naman sa mga tumataya, gaano karaming beses na kayo tumaya? At sa sobrang daming beses na tumaya na kayo, nanalo na ba tayo kahit minsan? So kung hindi man tayo nananalo, bakit hindi tayo tumitigil sa pagtaya? Is it because of the chance that you can be an instant millionaire kapalit ng 24 pesos na bawat taya mo? Have you ever thought kung gaano kalaki yung chance na hindi ka mananalo as compared dun sa chance na ikaw ay pwedeng maging instant na milyonaryo? Or kung hindi man sa loto, have you ever tried itong mga scratch cards na nasa mall? Wherein, kapag in-scratch mo yung card, you'll get some combination that would give you some rewards, most likely mga 200 to 500,000, so depende dun sa mga cards na yan. And then, that is just out of the 20 pesos na i-spend mo kada card. At kadalasan pa, kada scratch mo ng card, ang lumalabas ay try again next time or better luck next time, yung mga ganyang messages. Kaya naman ang tanong, naisip ba natin na bago tayo mag-scratch ng card na yan or bumili with our 20 pesos na sa libo-libong cards na na-print na yan, ilang combination or ilang card kaya yung merong combination para sa jackpot? Or meron pa talagang printed na para sa jackpot? Maybe some of you will not care because 20 pesos lang ang ilalabas mo kapalit ng possible na 200 up to 500,000 na prize. Pero for some, hindi sila maglalabas ng 20 pesos because they think na sobrang baba lang ng chance for them to have that 200 to 500,000 pesos na prize. Another question here is, are you a risk taker? Kung dati tumataya ka sa loto kasi 24 pesos lang, what if this time, let's make it 1,000 pesos kada taya? Are you still willing to spend 1,000 pesos kapalit ng chance na pwede kang maging milyonaryo? Or this time, you would think na hindi na worth it yung maliit na chance na yun kapalit ng 1,000 pesos mo? Alright, so welcome back on our review on management advisory services. So today we're going to talk about risks and rates of return on all our investments. The reason why we invest our money is because we are expecting returns. Ibig sabihin, pag nilabas natin yung pera ngayon, we are expecting na mas marami yung babalik sa atin after some time. So, return is defined as the total gain or loss experienced on an investment over a given period of time. At para malaman natin yung rate of return natin for a single asset muna, so that would be ano ba yung amount received natin minus all the amount invested over the total amount that you invested. When we say single asset, meaning if we have the total investment of 1 million, nakalagay lang yan sa iisang investment, let's say for example for stock A, and the expected return here is 15%. Pero kapag i-divide natin itong total investment of 1 million into different stocks, we now call it as the portfolio. Ano ba yung portfolio? That is actually the hands-off or passive investment because we are not really the one making money. So we just let our money make money for us all as well, and we just wait for the some earnings. And then this portfolio return can be computed using the weighted average of the expected returns on individual assets in the portfolio. This is just an example of a portfolio wherein your total investment is 1 million pero nakakalat siya sa stock A, yung kalahati, at with expected return of 15%. And then kay stock B may 200,000, expected return na 6%. And for stock C, yung remaining na 300,000 invested because may expected return tayo na 9%. So nakakalat yung 1 million natin. So if we hold our assets in a portfolio, that is less risky as compared to the asset held in isolation. So halimbawa, lahat ng pera mo nasa stock A lang. Bumagsak ang stock A. Ibig sabihin, lahat ng investment mo babagsak na. Pero if you put your money in stock A, B, and C, bumagsak si A, at least may chance pa tayo kay B and C na baka yun ng dalawang stocks na yun ay makabawi naman. Okay? So it doesn't matter kapag nasa portfolio, if the stock goes up or goes down, ang importante sa atin is overall yung return on the investments na portfolio, as well as the risk of that portfolio. This time, let's talk about risk. When there is risk, there is uncertainty. This is the chance na yung desired output natin will not happen. Pero sabi nga natin, pag hindi tayo nag-take risk, hindi rin natin makukuha yung return that we want. Okay? And sabi nga din ni Benjamin Franklin, in this world, nothing can be said to be certain except for death and taxes. And how much risk are we willing to take? So, depende po yan sa ating preference. Okay? Some people could be risk averse. Ito yung mga sigurista. They do not want to take risk. Iniiwasan nila yung risk. Di baling mababa yung return basta alam niya yung risk compared sa higher return pero unknown naman yung risk natin. And when choosing between opportunities na same naman yung return, they would always prefer yung mga mas mabababa lang yung interest or yung risk. The second group of investors are called risk indifferent. Ito naman yung mga hindi tumitingin sa risk. They are focused on the expected return. So, indifferent yung decision niya. It doesn't matter kung anong level ng risk niyan. Basta ang focus lang niya ay sa return. Okay, and the third one is risk seeking. Ito naman yung mga palahanap ng risk because they really think na that the higher the risk, the more return that they could get. Kaya every time na mimili sila ng investment, dun siya sa mas mataas ang risk kasi mas mataas nga yung return that could give them. And based sa research, Filipinos are generally risk averse. Mga sigurista tayo. And that is according to Ilagan in 2013. Let's take a look at these two investments. Okay? Yung una, it offers us guaranteed na return of 1,000. Yung pangalawang investment, 50% lang yung chance pero that would give you either 2,000 or wala at all. Okay? So the expected value from these two are just the same. Why the same? Kasi ito 1,000, ito 2,000 or nothing. Getting the weighted average, 50% chance naman times 2,000 is 1,000. 50% of nothing is 0. So meaning the expected value here is 1,000 as well. Pero with this one, you have the chance to earn up to 2,000 pesos. But you also have the chance to earn nothing. So which one will you choose? If you decided na kahit alin dyan, pwede na yan, meaning you are risk indifferent. Because you are not looking at the risk, you are looking at the expected return. Parehas lang naman, so it doesn't matter. So it's A or B if you are risk indifferent. Pero pag pinili mo yung letter A, guaranteed return, naninigurado ka na merong return na 1,000, you are risk averse. Pero kapag ang pinili mo ay yung B, because sayang naman yung chance that you could earn up to 2,000 pesos, pero of course, may chance din na wala kang kitain at all. So, risk-seeking ka if you are to choose investment B. Okay, just a quick check. So, which of the following results from forces outside of the firm's control and is therefore not unique to a given security? Is it liquidity risk, principal, inflation, or all of the above? The answer is inflation risk, because this is systematic and non-controllable and non-diversifiable risk. So talking about the types of risk, so we have two types. The first set of risk is called your systematic risk. These are non-controllable and non-diversifiable na mga risk. Under the systematic, we have currency risk. Ito yung chance na maapektuhan yung business operations or yung value ng investment natin because of the changes in the exchange rate. We also have equity risk, the chance na bumaba or tumaas yung market value ng ating shares or stocks. And then we have the inflation risk, the possibility that the value of our assets or income will be lower because inflation, hinihila niya pababa yung purchasing power of a certain currency. And we also have interest rate risk. That is a possibility na yung value ng ating security, particularly yung mga bonds, na maging mas mababa because of the increase in the interest rates. And if you will notice, all of these are generally beyond our control. That's why it is called non-controllable risk or non-diversifiable or the systematic risk. So another type of risk ay unsystematic risk. So kasama rito ang principal risk. So when you say principal risk, this is the chance na mawala yung entire investment mo because of possible na mabankrupt or magkaroon ng default. We also have credit risk. This is the chance na yung mga bond issuer, for example, will delay the payment of the principal as well as the interest. We also have the liquidity risk. This arises from difficulty in selling an asset. And we also have the call risk in case of the callable bonds. Merong risk sa cash flow natin in case na yung mga callable bond ay ma-redeem before the maturity. So, how do we measure itong mga risk na to? So, one way is through sensitivity analysis. So, we are trying to look at the side of optimistic and pessimistic. Whatever estimate that they set, that would be the range ng ating risk. And the higher the range that we have, the more variable is an asset. We also have the probability distribution. Pero ano ba yung probability? Probability is a chance that a given outcome will occur. So it's either it will definitely happen, probably, maybe, probably not, or definitely not happen. So parang ganun si probability. And gusto lang natin i-distribute na sa lahat ng mga chances na yan, ano yung percentage or probability distribution expressed in terms of percent. And the total is actually 100% or equal to 1. We also have the standard deviation and your coefficient of variation. Pag sinabi nating standard deviation, this is the measure of dispersion. So it measures how spread out a data from the mean. So look at this, okay? So on your x-axis, that is your test score, and then that is your frequency. So when we talk about standard deviation, so we have two sets here. Kapag makipot lang yung ating figure, ibig sabihin mababa lang yung standard deviation. Pero kapag ganito kalawak, mula rito hanggang dito, there's large standard deviation. So malawak yung mga plus and minus sa mga points from the mean natin. Okay? So if you look at this, mas malaki yung risk dito sa mas malaking standard deviation because the chance na ito yung maging return or ito yung maging return natin parehas na mataas. Pero ito, there is a low risk kasi alam mo na halos pare-parehas lang yung magiging result, maliit lang yung deviation. It's just a plus or minus sa ating mean. And to reduce the risk, we can do diversification. So there are assets or investments that are perfectly positively correlated, like this one. Na habang pag tumataas yung isang investment, tumataas din yung kabila kasabay ng kabilang investment. May mga perfectly negatively correlated naman na kapag bumaba yung return ng asset na to, tumataas naman yung return ng asset na yan. So they move in different directions. Okay? So, it is best to combine or add to the portfolio assets that have a negative or a low positive correlation. Why? Halimbawa, nagkaroon ng krisis sa part na to, na-strike yung industry na yan. Both your assets or both your investment will be affected. Pero kapag ganito ang nangyari, kung magkaiba sila na nagkaroon ng problema sa industry na to, most likely hindi naman affected yung kabila. Pero just in case na affected yung kabila, pero at least mababa yung chance as compared kapag pareha sila ng movement, kapag merong positive na correlation yung ating mga investments. In other words, kapag nag-invest tayo, wag natin pagsama-samahin sa iisang basket or sa iisang investment lang lahat ng pera natin, ikalat natin. At magkaiba sana yung correlation or negative yung correlation para malugi man yung isa, may chance pa rin na yung isa ay hindi na lulugi. This time, let's talk about the portfolio return using CAPM. So, this model shows the relationship between the expected return and the risk of investing in a security. It indicates also yung market sensitivity on the of the portfolio. Tapos, ito ang model na to is based on the proposition that any stock required rate of return ay equals sa risk-free rate of return, the risk premium, and the risk premium reflects only the risk remaining after diversification. So let's talk about the formula of CAPM. So this is your required rate of return. This is your risk-free rate plus your beta times your RM minus RF. Wherein your R is the required rate of return, the risk-free rate for RF, RM is your expected rate of return of the market. Okay? And then B is your volatility of the asset in relation to the market as a whole. So, mas mataas na B, mas mataas na return ang ina-expect natin or nire-require natin. The formula can be simplified as your R equals RF plus beta times RPM. The RPM here is your risk premium. Okay, the risk premium is the difference between your expected rate of return in the market minus your risk-free rate. So this time, let us solve the 23 problems that I prepared for you. Let's start. Problem number 1. The question is, what is the firm's expected rate of return? So provided that Bautista's stock has 50% chance of producing 25% return, 30% chance of producing 10% return. As you can see, may mga probability tayo at may mga expected return. So, gawa lang tayo ng table ng probability for PI and then RI for your return. So, we have 0.5, the 50% chance, 25% ang return. We also have 30% chance, so that would be 0.3, and that is for 10% return. And 20% chance here, 0.2 times negative na 28% na return. So, imumultiply lang natin yung probability with the rates of return. And then, that would be 0.5 times 25. So, that is 12.5. And this is 3. So, 0.2 times 28%. That is negative 5.6. So, ang ating expected rate of return ay 12.5 plus 3 minus 5.6. So that would be 9.9% for problem number 1. In problem number 2, we are asked for the coefficient of variation. Okay? The coefficient of variation is simply the you have to divide the standard deviation by your expected na return. Expected return is R bar. Okay? In this example, ganito muna tayo, but later on, we will compute for the standard deviation. But this time, given muna. So, just to show, that is simply 30% divided by the expected return of 25%. So, the answer would be 30 divided by 25. So, the answer is, ulit, 30 divided by 25. So, that is 1.2. That is a coefficient of variation. Okay, problem number 3, we're asked for the coefficient of variation, but this time, the standard deviation is not given. So, we will compute for the standard deviation. So, we will first compute for the expected rates of return. Ito yung probability natin. So, ito yung ating mga returns for the respective na mga states of the economy, boom, normal, and recession. So, what we're going to do to get the expected rate of return, we just multiply the probability with the expected return sa kada state of the economy. So, 0.45 times 0.25, so that would be 0.1125. 0.5 times 0.15. So this is 0.075. 0.05 times 0.05, and that is 0.0025. So the total here would be your expected rate of return. So that would be 0.1125 plus 0.075 and 0.0025. So the answer is, the average rate of return is 19%. Okay? To get the standard deviation, ang kailangan natin gawin is to multiply the probability with the difference of each expected return dito sa average rate of return natin. Square natin to. Okay? So, ulitin natin. So, for example, for boom na state of economy, so that would be 0.25 minus 0.19, i-square natin, and then multiply natin ng 0.45. Sample, so 0.45 times 0.25 minus 0.19 squared. So, let's compute. So, 0.25 minus 0.19 square natin, so times 0.06 times 0.45. So, the answer in the first one is 0.00162. So, we'll do the same for normal and recession. So, that would be 0.15 minus 0.19. That's a negative 0.04 per square naman. So, times 0.04 na negative din. And then, multiply natin ang probability na 50% times 0.5. So, that would be 0.0008. And for the third one, 5% minus 0.19. So, 0.05 minus 0.19. So, negative 0.14. So, times 0.14 ulit na negative. So, positive na siya. Times the probability of 0.05. So, the answer is 0.00098. So, please get the total. So, that would be plus 0.0008 plus 0.00162. So, the total here is 0.0034. Ang standard deviation natin is equal to the square root of our answer here. So, that would be PI R minus R bar squared. Or simply, standard deviation is the square root of your 0.0034. So, ang standard deviation natin ay square root nito 0.0583. So, remember, tinatanong ay coefficient of variation. Ang formula natin ay standard deviation over your expected na return or average return na 0.19. So, that would be 0.0583 divided by 0.19. So, our coefficient of variation ay 0.0583 divided by 0.19. So, the answer is 0.3068. Okay? Okay, problem number 4, we are asked again for coefficient of variation. But this time, mas marami ng states of the economy. So, the analyst has estimated how a particular stock's return will vary depending on what will happen to the economy. So, if you can see, kapag recession, negative 60% ang return, so loss tayo. Pero pag boom, up to 90% ang pwede natin kitain. Pero if you look at the profitability, actually this is probability of state occurring, 10% lang sa recession and 10% sa boom. So most likely this is 40% tayo pagdating sa average na state of the economy. So again, to compute for the coefficient of variation, the formula is standard deviation over the expected rate of return, yung average natin. Okay, so let's get the R bar or average rate of return. So what do? We simply multiply yung ating probability and ating expected return. So this is 0.06 pero ito ay negative. This is 0.02 negative din. This one is 0.06 na positive. And then this one is 0.08. And we have here 0.1 and 90%, 0.09. Okay? So the total na rate of return natin would be 0.15. And that is our average rate of return, 15%. Okay, let's get the standard deviation. Ang gawin muna natin, multiply natin yung probability sa Ri minus the R bar. Square natin tong difference na yan. So, Ri, itong negative 60. R bar is itong 0.15. Okay, so, let's do this. So, 0.6 negative minus 0.15, so that is 0.75 na negative, square natin, so times 0.75 negative, that is 0.5625, multiply natin ang probability na 0.1, so the answer is 0.05625. And then for the second one, we have 0.10 minus 0.15, so 0.10 na negative minus 0.15, negative 0.25, square natin. Ayan, and then multiply natin ang probability na 0.2. Okay, so this is 0.0125. And then for this one, 15 and 15, so 0 tayo kapag average. And then for this one, 0.4 minus 0.15, so that is 0.25. Square natin yung 0.25, 0.0625, times the probability of 0.2, so that is 0.0125. Okay. And then for this one, 0.9 minus 0.15, that is again 0.75. So kamukha lang din na nasa kabila, pero this time positive lang, 0.75. So the answer is also 0.05625. So ang total natin ay 0.05625, plus 0.0125 plus 0.0125. Okay. So ang total natin ay 0.1375. And to get your standard deviation, kunin lang natin yung square root ng answer natin dito, ng 0.1375. Therefore, your standard deviation is square root 0.3708. Kaya naman, if we substitute the answers here, so that is 0.3708 divided by your average rate of return of 0.15. So your answer divided by 0.15 is 2.472. So that is your coefficient of variation. Okay, problem number 5. The question is, what is the required rate of return on the market? So this is a CAPM problem. So remember the formula. The required return is your risk-free rate plus your beta times your RM minus your RF. RM is your required rate of return on the market. Ito po yung nawawala. Okay? So, ang required rate of return ay given na 11.75%. And that is equal to the risk-free rate, hinahanapin natin, that is 4.3%. Plus, beta natin is 1.23. So, yung nasa loob, RM yung nawawala, minus the RF of 4.3. Okay? So, let us simplify this one. So, 11.75 minus 4.3. So, that is 7.45 pag nilipat to doon. So, that would be 1.23 times RM minus 4.3. Okay, so, i-distribute natin to. So, 1.23 RM minus 1.23 times 4.3. 5.289. So that is 7.45. So to get your RM, so that would be, add natin si 5.289 plus 7.45. Okay? I-divide natin ng 1.23. So your answer is 10.36%. So that is your answer for number 5. Problem number 6. So we are asked for the market risk premium. So remember the formula, R is equal to RF plus beta times RM minus RF. At itong part na to, yung ating risk premium. Okay? So let's check. So a stock has an expected return of 12.25. So ito po yung 12.25. And the beta of 1.15 and risk-free rate of 5%. Okay? So that would be 12.25 is equal to RF na 5 plus beta na 1.15 times the risk premium. So, madali lang siya. Ilipat lang natin dun si 5 and get the value of RPM. So that would be 12.25 minus 5 divided by 1.15. So, ang ating risk premium ay 6.30%. So that's the answer in number 6. Okay, number 7, we're going to calculate the required rate of return for Castillo assuming na that investors expect 5% rate of inflation. So this time, i-include natin yung effect ng inflation sa pag-compute ng expected rate of or required rate of return. So ang alam natin na formula is R is equal to RF plus beta, RM minus RF. Pero pagdating sa RF, that would be the sum of your real risk-free rate plus your inflation na percentage. Okay? So ang RF natin would be, sabi rito, 5% ang inflation natin. Okay? And then the real risk-free rate is equal to 3%. Therefore, ang risk-free rate natin ay 8%. So yun yung gagamitin natin dito sa RF natin. Okay? So yun lang naman yung gustong i-emphasize sa problem number 7, yung effect ng inflation sa computation natin. But take note real risk-free rate yung binigay. Kung risk-free rate na yung binigay, yun na mismo ilalagay rito. Pero sabi, real risk-free rate. So therefore, to get the RF, i-add mo yung inflation at saka yung real risk na free rate. So, to answer the question, R is equal to 8 plus. Ang beta natin is 2. Okay? And your RM is not given. But ang binigay naman dito ay market risk premium. Remember, yung difference nito ay market risk premium na, and that is 5%. So be careful with that kasi minsan napagkakamalan to na the average return in the market na RM. Buti na lang, 5 lang to, RF is 8. So 8 plus 10, so the rate of return that is expected is 18%. So here is another problem for the required rate of return. So R is equal to RF plus beta, RM minus RF. So automatic na sa atin tong formula ni CAPM. Okay? So ang beta natin is 1.1, meron. Real risk ang binigay. So meron din tayong 3% na future inflation rate. So therefore, ang RF natin, if we compute, that would be the real risk na 2 plus the inflation na 3. So that would be 5%. Okay? So meron na rin tayong RF. And then the market risk premium. Oops, risk premium na yung binigay. So therefore, ito na mismo yung 4.7. Okay? So that would be R is equal to RF na 5 plus ang beta natin ay 1.1. Multiply natin ng 4.7. So the answer is 1.1 times 4.7 plus 5. So the answer is 10.17%. That is the required rate of return for problem number 8. Here is our problem number 9. So Marsigan is holding a stock na may beta of 2 and is currently in equilibrium. So the required rate of return on the stock is 15%. Okay, so that would be your R, 15%. And then the return on average stock is 10%. So that is your RM, 10%. Okay, and then what would be the percentage change in the return on the stock if the return on average stock increased by 30%? So, ibig sabihin, itong RM nag-increase ng 30%. So, multiply natin ng 1.3. So, magiging 13%. While the risk-free rate remain unchanged. So, whatever RF that we have here, same lang dito sa ating bagong scenario. Okay? So, let's compute to get the percentage change in the return on the stock. Kunin natin yung bagong required return on the stock. Okay? So that would be RF plus beta, RM minus RF. So R would be RF. Hindi binigay yung RF natin. But from the previous year, pwede natin na makompute. So that would be R is equal to 15 plus 15 equals your RF plus your beta RM minus RF. Okay? So 15 is equal to ang RF natin na nawawala plus ang beta natin ay 2. Ang RM natin ay 10. Ang RF natin ay nawawala. Okay, so let's compute for your RF. So ito ay distribute lang. 15 is equal to RF plus 20 minus 2 RF. So from here, RF natin is equal to 5%. Okay? So, gamitin natin yung RF dito. So, that would be 5 plus. Ang beta natin ay hindi naman nagbago. It is still 2. And then, ang RM natin is magiging 13% na minus your RF na 5. Therefore, your new required rate of return is 13 minus 5 times 2 plus 5. So that is 21%. Ang tinatanong ay percentage change in the return on the stock. So percentage change is equal to 21 ngayon minus 15 dati. Over ang ating denominator ay yung dati na 15. So that would be how many percent? 21 minus 15 divided by 15. So the answer is 40% na increase. Okay, so that would be the increase in our required rate of return. Problem number 10. Basa muna tayo ng question. So when all of these changes are made, what will be the difference in the required returns on Orca and Reyes na stocks? Okay? So here, magko-compare tayo kahit di pa natin nababasa entire problem, Orca and Reyes. So, si Orca, ang beta niya ay 2. Si Reyes, ang beta niya ay 0.5. Okay? And then the risk-free rate is 10%. Okay? So, ang RF ay 10%. The required rate of return on the average stock is 15%. So now, the expected rate of inflation built into RRF falls by 3 percentage points. So, dating 10%, magiging 7% na lang yung ating RF. Okay? And then the real risk-free rate remains constant. The required rate or the required return on the market falls to 11%. So, ang RM natin ay 11%. And then, the betas remain constant. Okay? When all these changes are made, what will be the difference in the required returns on Orcas and Reyes stocks? So, that would be, computin lang natin for each of the company. So, R is equal to RF na 7 plus, ang beta niya ay 2. And then, ang risk premium ay 11 minus 7. So, ang required rate of return ni Orca ay times 4 plus 7. So, that would be 15% kay Orca. And then, for Reyes, that would be equal to 7 plus 2, times 0.5 rather. That is 11 minus 7. So, ang required rate of return kay Reyes ay 0.5 times 4 plus 7. The answer is 9%. So, ang difference nila ay 6%. Mas malaki ang required rate of return ni Orca. Why? Lahat sa kanila parehas maliban sa beta. So, mas mataas ang required rate of return and that would also mean na mas mataas yung risk ng stocks ng kay Orca. So, let's now move to problem 11. Okay, so ito yung problem 11. Ang tinatanong naman ay difference between Dilusan's and Anselmo's required rates of return. So, another comparison kay Dilusan and Anselmo. So, Dilusan has beta of 0.7 while Anselmo has beta of 1.2. Okay, and 0.7. The required return on the stock market is 11. The risk-free rate is 4.25. So, parehas na parehas ang mga ibang data natin. Given the beta of Dilusan and Anselmo, which one do we expect na mas mataas na required rate of return? So mas mataas ang beta ni Anselmo, siya kaya ang may mas mataas na required rate of return. So, let's see. Kay Dilusan, that would be risk-free na 4.25 plus ang beta ay 0.7 times 11 minus 4.25. So ang required rate of return kay Dilusan ay 11 minus 4.25 times 0.7 plus 4.25. Yan. So 8.975%. So what do we expect? Mas mataas kaya kay Anselmo? Let's check. So R is equal to 4.25. Everything else is the same. Mas mataas itong multiplier natin na beta. Mas volatile dito kay Anselmo. So therefore, we are expecting more kay Anselmo. So that would be 11 minus 4.25 times 1.2 plus 4.25 is equal to 12.35%. So what is the difference between the required rates of return? Get the difference. Minus 8.975. The answer is 3.375% higher si Anselmo. Okay? So with higher na beta, mas mataas din ang required rates of return. Same with problem number 10. So let's move to number 12. So problem number 12 is asking for the required rate of return din. Pero may konting difference lang sa mga scenario dito. Okay, so Morales has a beta of 0.88 and expected dividend growth rate of 4% per year. So the T-bill or treasury bill rate is 4% and then the T-bond rate is 5.25%. So yung risk-free rate natin, saan natin i-base? Sa 4% or sa 5.25%? Normally talaga, naka-base ang ating risk-free rate sa government bonds na long-term. So, bakit naka-base sa government? Kasi risk-free rate, kasi most likely, kapag sa government tayo nag-invest, most likely, walang lugi. Or malugi man yan, medyo napakaliit lang ng chance. Kaya lang, since maliit ang chance, maliit ang risk, maliit din yung return. Kaya naman, ang gagamitin natin na risk-free rate ay itong 5.25% instead of 4%. So take note of that. So, the required rate of return is your risk-free na 5.25 plus yung beta natin na 0.88 times. Sabi rito, the annual return on the stock market during the past 4 years was 10.25. Investors expect that the average annual future return on the market to be 12.5%. Therefore, itong 12.5 ang gagamitin natin na RM. So, minus the RF of 5.25, what is the required rate of return? So, that would be 12.5 minus 5.25 times 0.88 plus 5.25. So, the answer is 11.63%. So, simple lang computation, but sa problem, make sure na pag nagbigay ng T-bill at T-bond rate, you make use of the T-bond rate. Okay? Pag nagbigay ng annual return on the stock market in the past year as compared with the future return on the market, we are going to use this 12.5, yung nasa future return on the market. Okay? So, that's problem number 12. So, in problem number 13, ang tinatanong pa rin ay required rate of return on the market. So, the return of Marvin Christian Incorporated or MCI are listed below. So, for years 1 to 5, meron tayo for Marvin Christian Incorporated. Ito yung mga returns. Pero in the market, it would be itong data na to. Okay? And then, we are asked for the required rate of return. So, to get the R, that would be the RF plus beta, RM minus RF. So, R is equal to, ang risk-free rate ay 9%, plus, wala nga lang tayong beta. Pero ang RM natin ay required return on MCIC stock is 15%. So, ibig sabihin, kung 15% pala ang required return on MCIC stock, ito pala yung 15%. Ang hinahanap sa atin ay required return on market, which is yung RM natin. Okay? Walang beta, walang RM, minus the RF na 9. And that is equal to 15. So, how do we find our beta here? So, we have to think on the rise over run or the slope. Okay? So, we just get any of the two data here. So, ang beta natin is equal to rise over run. Okay? Wherein MCI ang numerator natin. So, let us just make use of kahit year 3 and year 2. So, that would be 22 minus 16 over 15 minus 11. Again, slope nito, 22 minus 16 over 15 minus 11. So, what would be the answer? So, 15 minus 11 is 4. 22 minus 16 divided by 4. So, beta is 1.5. Okay? So, i-apply na natin dito. So, 9 plus 1.5 RM minus 9 is equal to 15. So, this time, compute for RM. So, ilipat doon yung ating simplify natin equation. So, that would be 9 plus 1.5 RM minus 1.5 times 9, that is 13.5 is equal to 15. So, let us simplify. So, lipat doon. Plus 15 minus 9 divided by 1.5. So, ang required return on market is 13%. So, this is the answer in number 13. So, we did that. Itong computation ng beta natin na rise over run because it says here that the market is in equilibrium. So, let's try to solve problem number 14. So, kanina, ang mga sinusolve natin ay para sa mga single assets lang. So, this time, we will start solving yung mga problems na may kinalaman sa portfolio. Okay? So, meaning there are 2 or more na mga investments. Okay, so we are asked to compute for the portfolio's beta. So, Bansal Corporation has 100,000 invested in a 2-stock portfolio. So, 35,000 in stock X, and then the remainder is in stock Y. Okay? So, ang beta ni X ay 1.5, ang beta ni Y ay 0.7. So, how do we compute for the beta? So, simply multiply, yung kay X kasi 1.5. Yung KY, 0.7. So, add natin yung beta niyan, pero you have to multiply it, itong kay X, ang investment niya ay 35,000 over 100,000. Ito naman kay Y, ang investment niya ay yung remainder na 65,000 over the total investment of 100,000. Kumbaga, kung makikita mo, i-allocate natin based on the proportion, mumultiply natin based on the proportion ng investment kay X at investment kay Y. Okay? So, to get the beta nung portfolio natin, that would be 1.5 times 0.35, 0.525, plus 0.7 times 0.65, 0.455. So, ang beta natin is plus 0.525. The answer is 0.98. So, parang kinukuha natin yung weighted average. So, 1.5 kay X, 0.7 kay Y. So, yung ating beta ng portfolio is between dun sa mga beta nung X and Y natin. Let's try to solve this problem number 15. Okay, in problem number 15, the portfolio's beta of Boss J holds 200,000 portfolio consisting of the following stocks. Kung makikita mo, naka-evenly distributed yung 200,000 sa lahat ng ating stocks from A to D. So, normally, ang ginagawa natin to compute for the beta, that would be 0.95 times 50 over the 200,000 and so on. But since equal naman yung investment nila, what you can do is just get the average of the beta of all the stocks. Okay? So to get the average, so that would be 0.95 plus 0.8 plus 1 plus 1.2. So the total natin ay 3.95 divided by 4. So the answer is, ang beta natin ay, ng portfolio natin ay 0.9875. Okay? So that would be our beta. Again, kapag equal yung investment, just get the average of the beta. Pero pag hindi, make sure na naka-proportion yung kanya-kanya nilang mga beta. Okay? So let's try number 16. Okay, so another portfolio na problem. So what is the required rate of return on the Superales portfolio? So that would still be the same formula sa CAPM natin na R is equal to RF plus beta times RM minus RF. Or simply ito, pwede natin palitan ng risk premium. Okay. So sabi dito, Superales company is forming a portfolio by investing 50,000 in stock A, which has a beta of 1.5, 25,000 in stock B, iba rin yung beta, which is 0.9. Okay? So the return on the market is equal to 6% and treasury bonds have a yield of 4%. So meron tayong RF na 4 and RM, meron tayong RM na 6. Okay? So what is the required rate of return? Ang kulang sa data natin ay yung ang ating beta. Okay? This is 4. So how do we get the beta again? So meron tayong mga iba't ibang stocks. 1.5 tayo para kay stock A. Magkano yung investment niya? 50,000. Kay stock B, ano beta natin? 0.9. Pero ang investment natin ay 25. Oops, ang total natin 50 and 25 over 75 tayo. Okay, naka-proportion ulit tayo pagdating sa beta. So that would be 0.5 times 1.5 divided by 75. So 0.01 plus, this is 1 rather, so this is 1 plus 0.9 times 25 divided by 75. So this is 0.3. So therefore, ang beta natin is between 0.9 and 1.5 and that is 1.3. Okay? And we're going to use that in our computation here. So this is 1.3. Substitute natin. So ang required rate of return natin is equal to 6.4. So 2 times 1.3. So that is 2.6 plus 4. So the answer is 6.6%. That is the required rate of return on the portfolio of Superales. Okay? So let's try problem 17. Number 17, the question is, what is the required rate of return on the new portfolio? So we have here 10 million mutual fund ni Buefano that manages a beta of 1.05 and the required return is 9.5%. So RF is 4.2% and Buefano receives another 5 million which she invests in stocks with an average beta of 0.65. So from here, it suggests na mag-compute tayo ng bagong beta natin. So that would be 10 million, 1.05 times 10 million. Okay, plus, yung bago natin ay invest sa beta na 0.65 times ilang million? 5 million. So, ang total investment ngayon ay 15 million. So, that is your denominator. Okay? So, ang bagong beta natin ay 1.05 times 10 divided by 15. So, this is 0.7 plus 0.65 times 5 divided by 15. So, that is 0.2167. So, ang beta natin ngayon ay 0.9167. So, tinatanong ang required rate of return on the new portfolio. So, that would be R is equal to, again, your RF plus beta times yung RM minus RF natin. Or pwede rin naman na R is equal to RF plus beta times risk premium natin. Okay. So, ang R natin ang hinahanap, ang RF natin ay 4.2% plus ang beta natin ay 0.9167 dito sa bago natin. Ang risk premium natin ay hindi binigay. Wala rin tayong required return on the market. So therefore, madederive natin yan out of the scenario bago tayo magdagdag ng investment. Okay? So, ang R natin before ay 9.5 and that is equal to risk-free rate na 4.2 plus ang beta before ay 1.05 times the risk premium. So, ang risk premium natin from here ay, so 9.5 minus 4.2, so divided by 1.05. So, ang risk premium natin ay 5.0476%. Okay? So, i-substitute na natin ngayon dito sa equation natin. So, times 5.0476. So, ang required rate of return rather natin on the new portfolio is equal to 5.0476 times 0.9167. Okay, plus 4.2. So, the rate of return na required ay 8.83%. So, that's the answer in number 17. Let's now proceed with number 18. So, here's number 18. So, what will be the beta of the new portfolio? So, masiglat, hold a diversified portfolio consisting of a 10,000 investment in each of 20 different common stocks. Okay, so pare-parehas lang amount kada common stock. So, in that way, pag nag-compute tayo ng beta, okay lang kahit hindi gumamit ng amount, we can just make use of the number of common stocks. Okay, so the portfolio beta is equal to 1.2. So, she had decided to sell one of her stocks, which had a beta equal to 0.7 for 10,000. So, she plans to use the proceeds to purchase another stock which has a beta equal to 1.4. So, anong beta ng new portfolio natin? So, before pala, ang ating beta ay 1.2. And that consists of the 20 na different common stocks. Pero it was mentioned here na yung isa natin ay 0.7 ang beta. Okay, so 0.7, that is 1 over 20. Ibig sabihin, yung 19 over 20, alamin natin kung ano yung beta. Because ito yung magiging beta nung matitirang stocks natin kapag binenta na natin itong stock na merong 0.7 na beta. Okay? So, your beta, after ibenta, si 0.7 would be 1.2 times 20. Okay? Minus 0.7 divided by, so again, 0.7, 1.2 times 20, ayan. Tapos minus 0.7 divided by 19. So the answer is 1.2263. So yan yung beta natin after natin i-retire or ibenta yung isang stock natin. Pero we're going to purchase using that proceeds another stock which has a beta of 1.4. Ibig sabihin, let us recompute the new beta wherein yung 19/20 natin, ang beta niyan ay 1.2263. Tapos ngayon, yung bago natin, bibili ulit tayo ng bago, that is 1.4 na beta. And multiply natin ng 1/20. Okay? So ngayon, ang beta natin ay 1.2263 times 19 divided by 20. So 1.164,985 plus 1.4 divided by 20. So this is 0.07. So therefore, ang bagong beta natin ay plus 1.164,985. Okay? So 1.235. Okay, that is our new beta. So that's the answer number 18. Alright, in number 19 naman, we are again asked for the required rate of return currently in sa portfolio natin. So, Alegre's portfolio consists of 100,000 invested in stock which has a beta of 0.8. So, 150, 1.2. And then 50,000 invested in stock which has a beta of 1.8. Now, i-compute na natin agad ano ba yung beta natin sa portfolio natin. So that would be 0.8 times ilan to? 100 plus itong isa ay 1.2 times magkano rito? 150 plus beta na 1.8 times magkano rito? 50. So, ang total ng investment natin ay 100, 150, 50, 300. Okay? So, let's compute for our beta. Okay, so that would be 80/300 plus 1.2 times 150. That is 180/300 plus 1.8 times 50. Tapos 90/300. So, ang beta natin ay 80 plus 180 again. 80 plus 180 plus 90 divided by 300. So, that would be 1.1667. That is our beta. And then sabi niya, the risk-free rate is 7%. Alright? And then the last year, this portfolio had a required rate of return of 13%. So this year, nothing has changed except for the fact that the market risk premium has increased by 2%. Pero hindi naman binigay ko ano yung market risk premium last year. Okay. So, yung 2% na yan is 2 percentage points. So, what is the portfolio's current required rate of return? So, tingnan muna natin yung nangyari last year. So, R is equal to, the required rate of return ay 13. And that is equal to 7 na RF. Okay? Plus, ang beta natin noon ay 1.1667 times the risk premium. Okay? And then, ang risk premium pala natin last year is equal to 13 minus 7 divided by 1.1667. Okay? So, ang ating risk premium dati ay 5.1427. So, this year, ang required return natin ay nahanap, that would be 7 plus 1.1667 times. Sabi rito, ang risk premium natin ay mag-increase ng 2%. So, therefore, it will now become 7.1427. Ito po. Okay? Dagdag tayo ng 2. So, ang required rate of return natin this time ay, so that would be 1.1667 plus 7.1427 plus 7%. So the answer is 15.31%. Let's check. 1.1667 times 7.1427. Ayan. Plus 7. So it should be 15.33%. Alright. Okay. So that is your required rate of return ng bagong portfolio natin this year. So let's try problem number 20. Okay, for number 20, tinatanong ang portfolio's new beta. Okay, so suppose Soriano holds a portfolio consisting of 10,000 investment in each of 8 different common stocks. So the portfolio's beta is 1.25. Now, suppose Soriano decided to sell one of her stocks that has a beta of 1. So, ibig sabihin, magre-recompute tayo ng bagong beta pag alis nung isang stock na to. And that proceeds would be used to buy a replacement stock with a beta of 1.35. Okay, so naganap siya ng mas mataas na beta. So, what would be the portfolio's new beta B? So, yung beta natin is 1.25. And that is equal to, pag nag-retire yung isa sa 8, so ang beta nung magre-retire ay 1. Okay? Times 1 over 8. Plus, yung beta na hinahanap natin na maiiwan dun sa 7 stocks. So that would be 1.25 times 8. Okay? Minus 1 divided by 7. So, ang beta nung maiiwan ay 1.2857. Okay, so with that, magko-compute tayo ng bagong beta kasi papalitan natin ng 1.35. So, therefore, the new beta would be equal to 1.2857 para sa 7 stocks natin. Tapos magdadagdag tayo ng isa, 1.35 yan, times 1 over 8. So, that would be 1.2857 times 7, ayan, plus 1.35, ayan, all over 8. So, ang bagong beta natin ay 1.2937. Okay? So, that's the answer in number 20. Okay, in number 21, the question is, what must the average beta of the new stocks to be to achieve the target required rate of return? So what happened here? Hilbuena, a mutual fund manager, has a 40 million portfolio with a beta of 1.0. The risk-free rate is 4.25 and then the market risk premium is 6%. Now, Hilbuena expects to receive an additional of 60 million which she plans to invest in additional stocks. After investing the additional funds, he wants the funds required and expected return to be 13%. So, hindi sinabi kung ano yung beta nung bago because that is the question actually. Okay? So, RF natin ay 4.25%. RPM natin or risk premium ay 6%. Ang R natin ay 13. So, una nating gawin, kunin muna natin ano ba yung beta ng overall pag nadagdag na yung 60 million. So, that would be R is equal to 13 ang target natin and that is 4.25 plus beta times the risk premium na 6. So, ang beta on the average, kasama na yung dati at saka bagong investment ay 13 minus 4.25 divided by 6. So, that would be 1.4583. So, kung yan yung na-expect natin na bagong beta, ang tanong, ano yung beta nung bagong dating na investment? So, ito pala ay equal sa, dito natin, so 1.4583. This is the beta new. Okay, nahanap natin yung beta. So that would be 40 million. Ang beta natin ay 1. Okay? Times 40 million. Plus, hinahanap natin itong beta na to times 60 million. So, ang total investment natin ay 100 million. Question, ano ngayon yung beta na dala-dala nung 60 million natin? So, that would be 1.4583 times 100. Ayan. Minus 40 divided by 60. So, the answer is 1.7638. That is our beta. So that's for number 21. So let's move to number 22. Okay, number 22. Camacho holds the portfolio given in the table below. So Camacho plans to sell stock A. Okay? And replace it with stock E, which has a beta of 0.75. By how much will the portfolio beta change? So with that, computein muna natin yung beta ngayon and compare natin sa beta kapag nadagdag na si E at nawala na si A. Okay? So what do we do? Multiply lang natin tong dalawa na to and then divide it later by 375,000. Okay? So 150 times 1.4, 210,000. So 50 times 0.8, 40,000. So 100 times 1, 100,000. So this is 75 times 1.2, that is 90,000. Please get the total. 90 plus 100 plus 40 plus 210. So the total is 440,000. Divide natin ng 375,000. So, ang beta natin ay 1.1733. Yan yung dati. Ipapalitan natin ng stock E itong si letter A. So, therefore, everything else will be the same kay B, C, and D except for A lang. So, 40,000 pa rin to. 100,000 pa rin to. And this is 90,000 pa rin. Pero for this one, kay stock E, that would be 150,000. Mumultiply natin ng 0.75 na lang. Okay? So that would be 0.75 times 150,000. So 112,500. Therefore, the total is plus 40,000 plus 100,000 plus 90. So that is 342,500 divided by 375,000. Okay? So that would be 0.9133. Ang tanong po, ano ang difference ng beta nila? Anong nangyari? So, minus 1.1733. So, bumaba po ng 0.26 yung ating beta. From 1.1733, naging 0.9133. Okay? So, that is number 22. And let's move to the last problem. Okay, for the last problem, we are asked for the stock D's estimated beta. So, ito yung mga investments natin kay A, B, C, and D. May mga beta na estimated. So, nawawala yung kay D. So, ang tanong, how do we solve for that? So, sabi rito, Apostol, Cruz, and Co. or ACO, actually it's ACC, company is managing the account of large investor. Okay, so with the following details. Ang total investment natin ay 15 million. Ayan. So, the portfolio's required return is 17%. So, R is equal to RF plus beta risk premium. So, R is equal to 17. So, ang RF natin daw ay 7% plus ang beta natin ay hahanapin natin. Kasi itong beta na to will help us para ma-compute yung beta ni D. Okay, and the risk premium is, sabi dito, the return on the market is 14. So, ang gawin natin, 14 minus 7. So, from here, we can actually compute ano ba yung beta ng average muna, ng portfolio mismo. Okay, so that would be 17 minus 7, okay, divided by 7. So, that is 1.4286. So, yan yung beta ng portfolio natin. Ang tanong, ano yung beta ng stock D? So, beta is equal to 1.4286. So, how do we compute for that? So, 0.8 tayo. Multiply natin ng 2 million. So, 2 na lang. Ang total natin ay 15 million. Okay? Plus, ito ay 1.1 times 5M over 15 million plus 1.4 times 3 over 15 million. And lastly, plus, tawagin na lang natin na X tapos times 5 million over 15 million. Okay? So from here, we can compute ano na yung value ng X natin or nung beta ng D. Okay, since ito ay 15 naman yung denominator natin sa lahat, i-multiply na kagad natin yung 15 by 1.4286. Okay, so that would be 21.429. Tapos simplify natin yung nasa taas. Ito ay 1.6. Ito ay 5.5. Ito ay 1.4 times 3, 4.2. At ito ay 5x. Okay? And this time, let's solve for x. So, 21.429 minus 1.6 minus 5.5 minus 4.2. Ayan. Divided by 5. So, the answer is 2.0258. Yan ang ating beta for stock D. And before I end this video, I'd like to thank these ladies, Miss Jonadel, Yvonne, Krisha, and Russell. Salamat galing sa kanila yung ibang laman ng video na to. Thank you so much. And for those who watched this video, salamat and I hope you have learned something. So if you have question, you can just leave your comments here. Thank you so much. God bless.